Bonus depreciation just got permanently restored to 100%. If you buy equipment in 2026, you can deduct the full cost in year one. And the modular construction market just crossed $292 billion, heading straight for $413 billion.
Plus, construction apprenticeship enrollment has surged 28% in just 5 years.
This is Construction Market Intelligence for March 29th. I'm your host, Justine.
And I'm your resident industry expert, Nicole. Welcome to Scaling Legends.
We've got some massive Sunday energy today because, honestly, we're looking at a fundamental rewiring of the financial landscape. Like, the ripple effects are going to hit your balance sheets by Monday morning.
Oh, absolutely. Our whole mission for this deep dive is to give you, the listener, a real strategic edge. We've been crunching the data source from Smart Business Automator to just, cut through all the noise out there.
Yeah, think of this deep dive as your ultimate pre-construction checklist for your business strategy. We want to make sure you have the financial, technological, and labor insights to actually scale.
Right. And we've got a really packed journey today. We're starting with that immediate tax relief, then moving into the massive modular boom.
Which is huge.
Oh, it's huge. And then diving into the labor pipeline, confronting some harsh realities about cash flow, and finally wrapping up with critical upcoming project deadlines.
Perfect. So let's jump right into the financial fuel here, this seismic tax news. Normally, tax depreciation is like a slow drip IV bag, right? You buy $1 million crane and the government gives you this tiny incremental drip of tax relief over like 5 to 7 years.
Yeah, it's painful.
It is. You have to plan around that slow drip. But as of this morning, it's like someone just squeezed the entire IV bag into the patient's arm all at once. The OBBB legislation just permanently restored 100% bonus depreciation.
And to really grasp the shockwave this is sending through the sector, you have to look at the cliff we were standing on. I mean, this tax break was actively phasing down.
Right. It dropped to 80% in 2023.
Exactly. 80% in 2023. Then it hit 60% in 2024, fell to 40% in 2025, and it was literally slated to choke down to just 20% this year.
Wow. And zero by 2027.
Yes. Absolute zero by 2027. We were staring down the barrel of full price capital expenditures, but now that phase down is entirely dead.
That's just wild. Imagine waking up today buying a $2 million fleet of excavators and wiping $2 million off your taxable income for the year by midnight.
It's a total game changer. And, it isn't just the bonus depreciation that got a lifeline. The Section 179 deduction limit was just doubled.
Doubled? To what?
You can now deduct up to $2.56 million up front.
Right.
And the phase-out threshold, the ceiling where that deduction starts to shrink, that's been pushed all the way up to $5.12 million.
Okay, so that's huge for mid-sized firms.
And they layered in 2 more massive provisions. First, immediate expensing for research and development is fully restored with a retroactive option back through July 4, 2026.
Oh, wow. Retroactive too.
Yeah. And second, there's a brand new acronym you need to know, the QPP, or Qualified Property Provision. It's a targeted deduction specifically for manufacturing facilities.
Right, so you can immediately write off specialized infrastructure inside a factory. Things like heavy climate control systems or robotic welding stations.
Exactly. So the immediate takeaway here is just to buy equipment now. Every single dollar you spend on qualifying assets is deductible in year 1.
But wait, I want to push back on this a little bit. With the phase down reversed, is there a real risk of mid-sized contractors suddenly over-leveraging themselves? Does financing a new fleet just for the year 1 tax break actually make sense if your project pipeline isn't guaranteed?
That is such a good point, and honestly, that's the exact trap that bankrupts eager contractors. A tax deduction is only valuable if you have the revenue to offset it and the cash flow to support the physical purchase.
Right, because if you finance $1 million worth of yellow iron and it just sits in your yard, that tax deduction does not save you from those monthly payments.
Exactly. The math has to tie directly to asset utilization. If your utilization rate on that new excavator drops below, say, 65%, the interest payments and maintenance will completely cannibalize the cash you saved on taxes.
Which is exactly why relying on gut feelings for capital expenditures is a total recipe for disaster. You really need to model these scenarios out.
You absolutely do. You need the data to back up every single purchase.
And that's where Smart Business Automator's financial planning tools come in. They specifically track this kind of tax optimization for equipment purchases, so you can see if buying that asset actually makes sense for your contracted project load.
Right. The companies that win here will be the ones running a strict cost-benefit analysis on every single machine.
Okay, so assuming you have the tax incentive and the backlog and the models all line up, Where's the smart money actually deploying that equipment? Because the data tells us it's increasingly not on the dirt at traditional job sites.
No, it's not. Capital's heavily flooding into off-site modular manufacturing.
Yeah.
I mean, the global modular market just hit $292 billion for 2026.
That is a staggering number.
And it's projected to reach $413 billion by 2031, which is a 7.16% compound annual growth rate.
Yeah, and the search analytics really confirm that shift. We're seeing a sustained 107% upward reversal for modular construction on Google Trends. It's an emerging multi-source confirmed trend.
It really is. And the heavy hitters are already carving up the market share. We're talking about companies like Clayton Homes, Skyline Champion, ATCO, Lang O'Rourke, and Sekisui House.
But the most revealing data point is where this growth is actually concentrated. Data center modules alone account for $61 billion in active deals.
Well, when you think about the AI boom, it makes perfect sense. Tech companies are in a global arms race for compute power, and they simply cannot wait for a traditional, multi-year stick-built timeline.
Right, they need these server farms operational yesterday.
Exactly. So they're buying them in prefabricated, pre-cooled modules. And healthcare pods like fully finished hospital rooms and residential builds are the other massive growth engines here.
So what's driving this sudden acceleration in M&A in this specific space? Like, why are investors suddenly so hungry for modular?
Because investors view modular as the definitive solution to the industry's twin demons, which are severe labor shortages and relentless cost escalation. Moving construction into a controlled factory changes the entire risk profile.
Because you eliminate weather delays entirely.
You eliminate weather delays, you drastically reduce material waste because software optimizes the cuts, and most importantly, you standardize the labor process. Workers go to the same station every single day.
Right. But it's not a perfect utopia, right? Let's talk about the friction points. Because transporting these massive modules down federal highways adds, 5 to 15% to the total project cost?
Yeah, transport is a huge added cost. And then there's the banking sector. Banks are incredibly hesitant right now. They are currently offering 5 to 10% lower loan-to-cost ratios for modular compared to stick-built projects.
Which is so ironic to me. If modular is the silver bullet for reducing project risk, locking in material costs and weatherproofing timelines, why are banks treating it like a bigger risk? Is it literally just because the asset isn't sitting on the final dirt yet?
That is exactly it. Traditional construction lending is entirely predicated on inspecting work in place on the actual real estate. The bank sends an inspector to the dirt, verifies a foundation, and releases the funds.
So you're asking a bank to finance millions of dollars of work happening in a factory 3 states away.
Exactly. On a physical asset that could theoretically be sold to someone else before it's ever bolted to your foundation. So the major players have to rely on institutional capital backing and specialized surety bonds.
Until the financial sector adapts, developers just have to bring more of their own cash to the table. Which, by the way, if you're trying to navigate this, Smart Business Automator actually tracks these modular construction companies and specific project opportunities.
It's a really phenomenal way to monitor where that capital is flowing, despite all the banking friction.
Totally. Now, even with modular offsetting some on-site labor, the industry is still actively trying to fill over 500,000 open jobs. We have to talk about the pipeline of human capital.
We do, and the labor data is actually surprisingly optimistic. Construction apprentices reached 480,399 in 2025. That's a 28% surge over just 5 years.
Wow, 28%.
Yeah, and nationally, there are 680,000 total active apprentices. We're looking at a 114% increase since 2014.
You can see it in the search data, too. The keyword construction hiring is up 125% on Google Trends. A lot of this comes down to earning potential, right?
Oh, definitely. Entry level starts around $35,000, but journey level professionals are hitting $65,000 to over $105,000, depending on the trade.
Right, but the organic interest isn't the only thing driving this. There's an unprecedented wave of federal incentives. The Department of Labor Registered Apprenticeship is now the undisputed gold standard.
Absolutely. The biggest lever is the Inflation Reduction Act, the IRA. It offers a 5x prevailing wage multiplier just for using registered apprentices.
I view that 5x multiplier like finding a hidden cheat code in a video game for contractors bidding on federal work.
It really is. Plus, there was $145 million in specific DOL grants available to help companies establish these programs.
And state programs are aggressively funding the trades, too. Louisiana has a tax credit, Texas just deployed a $6 million grant, and New Jersey put up $1.5 million.
Exactly. And with both ABC, the merit shops, and union apprenticeships growing simultaneously, we're really seeing a cultural shift.
Do you think the cultural stigma around the trades is finally dying out?
I do. The underlying economics demand it. You have 22-year-olds making $85,000 a year with zero student debt, buying houses while their peers are graduating with massive debt for entry-level corporate salaries.
The stigma just can't survive that math. So you've got the tax breaks, you're innovating with modular, and you've got a surging workforce. But if you don't manage the money flowing between these pillars, your business will flatline.
Cash flow is the silent killer here. A recent U.S. bank study showed that 82% of construction business failures are caused by cash flow problems.
82%, that is terrifying.
And right now, 74% of companies report they are actively fighting cash flow challenges.
But why is it uniquely terrible in construction? The data points directly to payment terms. General contractors wait an average of 83 days for payment.
That's nearly 3 months. On day 1, you pay your labor. Day 30, suppliers demand payment. You are bleeding cash for 2 entire months before a client even considers cutting you a check on day 83.
You're basically acting as an interest-free bank for your client. How do mid-sized contractors even survive that gap without completely over-leveraging themselves?
They often get forced into factoring receivables or taking high-interest bridge loans, which just completely cannibalizes their margins. And that assumes billing is accurate.
Right. Overbilling versus underbilling can cause a massive $400,000 to $500,000 cash swing on just a $5 million company.
The gold standard solution is maintaining a rigorous 13-week cash flow forecast. You have to map out exactly what cash is leaving and arriving every single week.
Yet most contractors simply do not do it because it's administratively exhausting. Surviving that 83-day gap means having total visibility into your cash and your project deadlines.
Which brings us to the radar for the next 6 months. We have some critical updates and ticking clocks.
Let's hear them.
First, CTA funding was just restored by Judge Durkin. We covered the suspension on Friday, but as of today, that $2.9 billion Walsh-VinCI transit project is active again.
That's massive news for the Chicago market. And on the East Coast, the Gateway Tunnel has an April 16th court date. That's just 18 days away.
Then, for energy and infrastructure, the DOE Spark program has its $1.9 billion funding applications due May 20th, which is 52 days out.
Right, followed by the AGC CMMC Demo Day on May 21st, and then the massive systemic deadline hits.
Yes, the IGA expires on September 30th, exactly 6 months from today.
So the window for easy federal infrastructure money is closing rapidly.
Federal agencies will be scrambling to allocate all remaining funds, creating intense urgency around applications like DOE Spark.
Plus, looking further out, CMMC Phase 2 hits in November 2026. If you touch federal data, your IT infrastructure has to be certified.
And don't forget the Work Zone Safety Compliance deadline dropping December 31st of this year. Managing all these specs and cyber requirements is a full-time job.
Exactly. Which is why keeping track of compliance deadlines, spec checking, and schedule risk detection is exactly what the AI project assistant inside Smart Business Automator is built for.
It acts as an automated assistant that tracks those deadlines without you having to manually update spreadsheets every Sunday night.
Yeah.
It automates the defense so you can play offense.
All right, before we wrap this deep dive up, I want to leave you with a final unmentioned scenario to really ponder.
Oh, I like this one. Consider this timeline. What happens when the newly restored 100% bonus depreciation collides head-on with the $292 billion modular boom?
That is a fascinating collision of incentives.
Could we see traditional general contractors who are completely exhausted by 83-day payment delays suddenly using their year-one tax deductions to just buy up modular manufacturing facilities?
Wow. Could they vertically integrate their entire supply chain utilizing the QPP deduction for factory tech and capturing that IRA 5X apprentice multiplier in their own controlled environments?
Exactly. That would completely rewrite the traditional general contracting business model. You'd go from managing chaotic subs on a muddy site to being a precision manufacturer.
The math is definitely pointing toward vertical integration.
It is a very real operational possibility given the massive financial incentives right now.
It's something to think about. All right, if you know a contractor who is dealing with 83-day payment delays or trying to figure out how to bid with apprentices to get that 5X multiplier cheat code, send them this deep dive right now.
Just text them the link.
And hit follow on whatever app you're listening on so you don't miss tomorrow's intel. Visit smartbusinessautomator.com to see how to scale without drowning in admin work. Have a great week.